what are the terms of these debts looks like if you plan on using them?
Yeah, it kind of varies, but typically you have senior debt and you might have junior debt as well. If you just have senior debt, that basically means that debt is, it takes precedent over anything else in the company. Um, it's like secured against the company. If you don't pay it, the lender can maybe take the company back, that kind of thing. And senior debt is usually lower cost of capital. So it might be, let's say, 7% interest or 6%. And it would probably amortize over, let's say, 5 years. So maybe it's like interest only for 6 months or a year. And then after that, it's just like a straight line. You've got 4 years to pay back that money plus the interest. And junior debt is usually at a higher interest rate, like let's say 12 to 15%, but it's more likely to be interest only, with a balloon payment at the end. And again, if you're buying a bigger business, if it's got more recurring revenue, more consistent revenue, maybe higher margin, and it's generally like considered a better business by the lender, they're more likely to do like a 7 year or an 8 year amortization. The other things that get impacted are, well, how much capital is available, and that might depend on the overall holding company. So, let's say we're a company that's doing 3 million in revenue and we want to borrow 7 million. That's going to be very difficult for a lender to get comfortable with. Even if you're buying a business, which maybe the business you're buying is 10 million, they're going to think, we're not really sure. But if it's the other way around and you're at 7 million revenue and you want to borrow 3 million, then it gets a lot easier. So that it's kind of like, what is the delta between what you want and what you are? And so, yeah, that's kind of why, as we scale, like if we're at 50 million in revenue and let's say we're at 5 million in EBITDA and cash flow positive, and then we say, hey, we want to borrow 2 million or 10 million to buy another business, which is going to give us 1 million extra in profit, lenders are going to say yes to that a lot more easily. So yeah, but that's the general like structure.
You have to give some collateral, right? So is it gonna be the business you're buying, or is it gonna be on the holdco?
Usually both. So again, different lenders have different requirements. So a lot of lenders will say, so definitely the business you're buying, there'll be a UCC or a lien on the business, and then if the holdco can guarantee that loan, then usually they'll do that. They won't necessarily want the holdco and all the other assets to be collateral. Sometimes they will, though, because it depends on your structure. Like, for example, they don't like seeing a lot of capital leave the business when, for obvious reasons. And so let's say you've got a business which is going to produce 100K a month in profit, and 50K of that needs to go to paying the debt and the interest and everything. If we say, well, then we want the other 50K to come up to the parent co so we can use it however we want, then they're more likely to want to have a guarantee on the parent co as well. Whereas if you say, no, that money can stay in the business or it's going to get reinvested into growing the business, we're just going to pay ourselves we're just going to pay the salary of the manager and maybe pay ourselves a small admin fee for the overhead that we incur, then they're going to be okay, and they probably won't want a guarantee on the holding co. And again, it also depends on the size. Like if the business you're buying can't really support the debt, but the holding co can, then yeah, they're going to want to bring that into the picture as well.
Got it. I think it's almost like it's not like a set in stone. It's all about, what the lenders thinks it's high risk or low risk and negotiate on the terms.
Yeah, I mean, there's a lot of it's about what you're trying to do, who you're working with, and who you are as a borrower as well.